All right, good morning, everyone. Welcome back to our fourth training here, talking about the Affordable Care Act and now heading into Pennsylvania. So our first portion this morning will be actually working with the 4012, the guides information that you have coming out of the IRS. After questions, we'll be working on the Pennsylvania, which will be completely different in terms of your instructional material that'll be coming out of your volunteer guide. And we'll talk a few issues about what's unique about the Commonwealth of Pennsylvania and their taxation structure. But first, I want to start about the Affordable Care Act, and you may have heard some interesting changes for the Affordable Care Act that will be applicable for next year. So for 2019, the shared responsibility payment that we're going to be talking about will not be in place. However, it is for 2018. So we're going to be going through a couple different issues here. And 2019 is still a long way away for tax purposes. So we'll see what ultimately happens next year. But theoretically, we're right in the midst of people signing up for health insurance through the marketplace. So we'll see how many people elect coverage next year. But do want to go through a couple major items with the Affordable Care Act. We're going to be talking about a couple items here. Predominantly, we're going to introduce some terms called minimal essential coverage, or MEC. We're going to be talking about the premium tax credit. We're going to be talking about some of the healthcare coverage exemptions for purposes why individuals may not be covered by insurance. And then we're going to be talking about a couple things specifically with the 1040 itself, including how do we report health insurance coverage, how do we take a look at reporting some of our premium tax credits, the exemptions, and kind of what I referenced there, the shared responsibility payment. So one of the things we're going to be taking a look at here is how we want to present the information. In most cases, what's going to happen is the taxpayer will fill out their intake sheet, and the question arises, do you have minimal essential coverage for the entire year? And usually that answer may be, I am unsure of what minimal essential coverage is. So we'll go through and we'll talk to you a little bit more about what minimal essential coverage looks like. But effectively what we need is every taxpayer, their spouse, and any dependent on their return, or anyone living in their household, is required to have one of three things: either minimal essential coverage, a exemption, or responsible for a shared responsibility payment for every month of the year. So we want to talk about a couple things first. Really, what is minimal essential coverage? And minimal essential coverage would be a type of health insurance plan that the taxpayer is participating in, or their spouse or their dependents. So the traditional one we'd see would be coming out of your employer context. If an individual is provided insurance through their employer and actively participating in an employer plan, that would be typically considered minimal essential coverage. The employers need to have their plans adopted to make sure that they meet the qualifications, but traditionally participating in employer-sponsored healthcare would meet minimal essential coverage. COBRA payments also count. So if someone is separated from service and continuing by paying COBRA premiums, that is also considered minimal essential coverage. If an individual has purchased individual health coverage, whether that's through the marketplace, whether that's directly from insurance companies, the new trend now is to have these insurance cafes popping up where you can come in, have a nice latte, and talk about your insurance needs. You can purchase insurance directly. So if an individual has coverage that they purchased either through the marketplace or directly from the provider, that is coverage as well. What we'll probably see is a lot of exceptions here for minimal essential coverage for people who qualify for minimal essential coverage based on a government plan. So Medicare, Medicaid, CHIP, any of those plans are going to be considered a government-sponsored plan and meet the definition for minimal essential coverage. So if you have an individual who comes in, they bring their SSA 1099 and they say, I don't know if I have minimal essential coverage, and you see that they have their Medicare premiums withheld, you're good to go. They are fine. We need to find out if they were covered for all the months, but that would qualify. Medicare, Medicaid, and particularly if you have children on a return, if they're under the age of 18, they would automatically qualify for CHIP. So they could enroll in the CHIP program if they do not have other coverage available. Now, what's unique, you do not need proof of coverage. So we do not need to see an insurance document. We do not need to see their insurance card. We do not need a picture of them with their primary care physician. If we get information from them that say they have insurance coverage, they have Medicare, they have insurance through their employer, that is fine. We're going to go through kind of our normal procedures to make sure that the information seems valid, but we don't need any additional information. And this is going to be actually fairly important for this year because the IRS has granted an extension for employers to file the Form 1095B with their employees. So the 1095A we're going to be talking about, that's coming out of the marketplace, but traditionally if you have employer-based coverage, you'll get a Form 1095B. IRS has already granted extensions to employers, so they don't need to have that to employees by January 31st. So you may have individuals coming in early. We do not need to hold the return up by saying we need to wait for that 1095B to come in. As long as they tell us that they have coverage through their employer and it sounds legitimate, we can go ahead and take that as a valid statement without proof of insurance. So there are a couple other pieces on the H6, which will go into a little bit more of what we consider the minimal essential coverage. But the main ones, again, are going to be employer-sponsored plans, if the individual has purchased insurance directly, or that they have it through a government-sponsored organization. So one of the first things we're going to take a look at is going through the questions in TaxSlayer. So one of the first things we'll see when we get to the ACA component is the question, did each person on the return purchase medical insurance through the marketplace or healthcare.gov? This question is going to be triggering a number of other things that we'll take a look at. Typically, if they have purchased insurance through the marketplace, they're going to be receiving a Form 1095A. We need that form in order to prepare the return. If they do not have the Form 1095A, we cannot prepare the return until we get a copy of it. Generally, they can go on and log into their account and download the form, but we do need to have that Form 1095A in order to complete it. So if we can answer that question, yes, that at some point in time, either they or someone on the return had purchased insurance through the marketplace, we need to have that Form 1095A to be able to complete the return. So that'll have a lot of detailed information that we'll be taking a look at. The main reason for it is that traditionally, if you're purchasing insurance through the marketplace, for individuals involved in VITA who qualify for VITA, they would also qualify for a premium tax credit. And a premium tax credit is based on their income levels and how much insurance coverage are they enrolling in. So the nice advantage for individuals within VITA is they can actually use those premium credits to offset their monthly cost of insurance. Now, the premium credit is going to go through a process as long as they're purchasing insurance through the marketplace. It does not count. You do not get a premium tax credit for buying insurance directly or through your employer. It has to be through the marketplace. And there are a couple things that we need to be ensure that the rules are in place. The marketplace will generally confirm that the individual is eligible to even participate in the marketplace, and also to confirm that they're eligible for the premium tax credit. So as long as they were not eligible for other minimal essential coverage, either through the employer or through other means, they can typically purchase insurance through the marketplace. And if they're purchasing through the marketplace and they were not eligible for insurance elsewhere, they can be eligible for the premium tax credit. What most of our clients will do is take this in the form of an advanced premium credit, meaning again that they'll use that money on a monthly basis to decrease the amount of insurance that they have. A couple things that we take a look at. In order to qualify, you have to meet a couple requirements. One is that you have to be over 100% of the federal poverty level. If you're under the federal poverty level, the marketplace will presume that you're eligible for Medicaid, and you will not be participating in the marketplace insurance. You also have to be under 400% of the poverty level, and you don't need to memorize these amounts. We actually have charts in our 4012, and we have some additional resources that will let you know where the individuals fall out. This is really for eligibility for the marketplace. We do not participate in getting people on the marketplace for insurance coverage, but we're going to be responsible for helping them report any activity. The other issue we have, if an individual is married, that they need to be filing a joint return with the spouse. There is kind of an exception here. If they file a married filing separate return because that there is fear of abuse or other types of issues or abandonment, they can actually file married filing separate return and still take the premium tax credit. So this is one of those areas where the married filing separately status is not one that you can take advantage of the premium credit unless there's some other reason why they're filing separately. And at the very top of the government forms, you'll see a checkbox to say if they're filing separately due to other circumstances. Probably not surprisingly, you may not be dependent on another return and still be eligible for the premium tax credit. So the government's not interested in subsidizing healthcare coverage for those that are actually going to be claimed as a dependent on someone's return. So that's the general rule for the premium tax credit. Now, again, what we're going to see more often is the advanced premium credit. This is going to be a little bit more information on H24 of your 4012. So again, when you apply for insurance through the marketplace is going to ask what your expected income is for the upcoming year. They will base it predominantly off the prior year, and you get to let them know if there are any major exceptions to it. And they will calculate what the advanced premium credit is and will quote your insurance after the credit is applied. So most of our clients in VITA will be getting the advanced premium credit. They'll be using that to offset their monthly insurance cost. One of the areas that we have to take a look at when we talked in the very first session about who has to file a return, if you have a 1095A and you had an advanced premium credit, the IRS needs you to file a return, irrespective of what your other situation is. If you don't have sufficient income, if your income falls beneath the standard exemption, you still must file a return if you have an advanced premium credit. So if you see a Form 1095A coming in, we're traditionally going to have to file an income tax return. Now, the 1095A is supposed to be received by January 31st. We'll see if that happens. In years past, they have not been necessarily coming in timely, nor always correctly. So there are a couple things we want to take a look at is to make sure that when you get that document from the taxpayer, that they're reviewing it, that they make sure that everyone who had coverage is listed on their 1095A. If they had been receiving a premium tax credit, that's listed correctly on the 1095A. If there is an issue with the 1095A, they need to go back to the marketplace and get that corrected. Fortunately, the marketplace is fairly easy to work with. There's a 1-900 call number. They can also log on to their account if they're computer savvy and be able to request assistance that way. But any error on the 1095A has to be directed back to the marketplace for them to correct. We can only use the information to prepare the return as shown on the 1095A. And if there is an issue, the taxpayer is happy to wait until we can get it fixed. Because we can only prepare the return as the 1095A is presented. And traditionally, if it's going out of their favor, they'll probably want to wait to make sure we get it done correctly so there's no repayment of credits or things along those lines. So what we're going to do with the information, fortunately, if we have the Form 1095A, we don't need to do any other calculation than entering into TaxSlayer. So once we get the information, TaxSlayer is going to go ahead and calculate whether or not that premium credit that the taxpayer received was an accurate number. In some cases, they may be entitled to more premium tax credit. In some cases, they're not. They actually got more premium credit than what they were entitled to. So we may be running into some issues where they have to repay all or part of that premium tax credit, depending again on some income thresholds. So TaxSlayer will automatically do the calculation for you. And in most cases within VITA, the people who are eligible to participate in the program will have limitations on the amount that they need to repay. But I just want to caution you, this is an area that we've seen a little bit more where people may have gone ahead to the marketplace and told them their income's a lot lower than what it's actually going to be. Or they may have some unexpected source of income, whether it's gambling winnings, whether it's a raise at work, maybe they're now employed, and will substantially change how much income they have. Now, what you'd probably want to do is to remind individuals if there's a substantial change in their lifestyle, marriage, children, change in income, they should contact the marketplace immediately. And the marketplace will change their premium credit. So if you have an individual who now all of a sudden took Social Security halfway through the year and forgot to tell the marketplace, their income is going to be a lot different than what they originally projected. So we may have an issue in terms of having to repay part of that premium tax credit. Again, TaxSlayer will go ahead and do the calculation for you. So it's really not too difficult to go through as long as we enter all the information correctly. So just want to kind of point out that you may see situations where an individual may have taken a premium credit, they've gone through the marketplace, they've gotten insurance, and yet they're going to have a payment due. And that's mainly because they took too much credit. And again, probably the best way we can walk through it, hopefully they have enough other refund opportunity to kind of absorb some of that premium repayment, but probably remind them to contact the marketplace as often as possible whenever there's a change in their circumstances, particularly if they continue with the process. Now, that's a good situation that they actually have insurance, they're actually participating through the marketplace, they're getting a reduction of their monthly insurance premium. Now, what do we do with the individuals that do not have insurance? If they come in, they say, we don't have insurance. So again, for 2018, and looking forward to 2019, this rule is going to change. But for 2018, for every month, the taxpayer, their spouse, dependents on the returner, and members of the household have to have either minimal essential coverage, qualify for a coverage exemption, or make a shared responsibility payment when they file the 2018 return. So we'll go through a couple calculations. Again, what we'll take a look at excuse me, would be minimal essential coverage. If they qualify for minimal essential coverage, they only need it for any part of that month. If they had insurance for one day in the month, that counts as having coverage for the entire month. So what may run into situations, you may have an individual who says, I was covered under my employer plan up through April 17th. I left my employer and then I applied for Medicare coverage when I turned 65. That coverage began on July 1st. So we'd have coverage through April because that would count as any part of the day. And we'd also have coverage beginning in July. That would be any day that the month that we are covered. So as long as they have coverage at one day of the month, they're considered covered for the entire month. So at least it gives us a little bit of opportunity to see how many months we're working with. Parents will be responsible for coverage for their dependent children. So if we're filing a return and we're taking dependents, we need to be sure that that child has coverage. Now, that may be possible that a parent has custody of a child, they're taking a dependency exemption, and that child may be covered under a former spouse's plan. Again, we just need to make an inquiry. Do you, your spouse, and any of your dependent children have minimal essential coverage? And it may be a circumstance where some people may have coverage, some others on the return may not, and we'll just have to go through kind of an individual by individual basis. But if someone tells us, I'm claiming a return, I'm head of household, I do not have coverage through my employer, but my children are covered through my former spouse, that's acceptable. We'll take that as a response that the children are covered and that they'll meet the minimal essential coverage. Now, when we take a look at the shared responsibility payment, a little bit more information here on the H-22. If the individual, the taxpayer or the spouse or their dependent does not have minimal essential coverage, and importantly, they do not qualify for an exemption for health care, then a shared responsibility payment is going to be calculated. We'll give you the numbers. The best part is you don't need to do the calculation. Our system's going to do it for you. Now, the interesting part about the shared responsibility payment is actually the greater of two numbers. Traditionally in VITA, we're probably going to see just the standard rate. Typically, if you go through the math, most of our VITA clients, if we take a look at the top issue here, 2.5% of the household income that is above the filing threshold. So that would be our first one. 2.5% of all of your income above a filing threshold. Most individuals coming into VITA are probably going to be in our qualification of income. So we may not see as many hitting this category. This is a pretty bad one. What it basically is penalizing is those who have a large amount of income, decided not to get insurance, and they're going to be contributing to the shared responsibility payment. What we'll probably see a little bit more is the second category, is a family rate. So it's $695 per adult. The rate is half for those of children of under age 18, so $347.50. One of the few times the government actually has cents in their calculations, which ironically will round up anyway. I'm not quite sure why we did do it a dollar. But I guess if you have two children, then you save yourself a dollar going through the rounding. So, but there is a family maximum. So the family maximum is actually $2,085. But it is going to be the greater of those two numbers. And TaxSlayer will do the calculation for you. The amount's also going to be capped going through a bronze plan as well. So there's a number of kind of details that go into this. This is a relatively complex calculation, which fortunately the software system knows how to do. For those of you who just enjoy eating sausage, this is what we're going to talk about. Those of you who like to know how sausage is made, we can spend 8 hours going through the calculations of how this is done. But basically what will happen, the shared responsibility payment, if they do not have minimal essential coverage, or if they do not qualify for an exception, will go ahead and be calculated automatically by TaxSlayer. So this leads right into our next question. So what are the exceptions to our coverage? Well, there are a couple things that we can actually claim here, either ourselves or to go through the marketplace. And H15 of your 4012 will give you a number of examples of what these are. If the individual has requested an exemption from the marketplace, we can enter that exemption number. It's traditionally an alpha or numeric number that comes through the marketplace. They'll get a form from the marketplace saying that they have a known exception, and you can enter that directly on the 8965. So that would be, the marketplace has already said you do not need coverage, you're fine. Another one that we see is going to be automatically calculated. That's going to be income below the filing threshold. So one of the things we're going to be noticing this year, which might be a little bit different, is the standard deduction has increased dramatically, which means the filing status has increased dramatically, your filing requirement. So your filing requirement would be if your income exceeds a standard deduction. So there may be more individuals now falling under this filing status category. The system will automatically calculate this and allow you to just check a box to say, yes, that's our exception. Our income's below the filing threshold. Now, there could be a couple other things, and this is going to be part 3 of the Form 8963. These are going to be our other coverage exemptions. And we're going to talk about these, and we'll talk about some of the more significant ones. We're going to spend a lot more time talking about coverage considered unaffordable. This is going to be Code A. This is the one area that we have perhaps more calculation than others. It's going to involve us going through a little bit of more detail, a little bit more inquiry, and will take a little bit more time to complete. This is generally going to happen whenever we have a taxpayer whose income's above the filing threshold, but they still have difficulties paying for insurance. The coverage considered unaffordable is if your insurance coverage cost is more than 8.05% of your income, then it's considered unaffordable. And we'll go through a couple different scenarios of how that's going to work, including a guide that we can walk through here. That is kind of our one that has the most amount of calculation. There are a couple other things that we're going to take a look at here in terms of short-term coverage gap. So if there's a gap in coverage, less than 3 months. So that means 1 month or 2 months. Those are our options. So not 3, it has to be less than 3. And again, what we're looking at is this will count as long as that coverage gap is less than 3 months. So if someone says I was out of coverage for a period of 1 month and 14 days, you're good. They were out of coverage for 2 months, you're good. They were out of coverage for 2 months and 3 days, you're not good. I'm sorry, I should take that back. You are still good with the 2 months and 3 days because any coverage in part of the month counts as a full month. I retract that last one. 3 months and 3 days is not a good scenario because now you're at beyond that short-term coverage. But what we want to take a look at with the short-term coverage gap is we actually have a unique provision called a look back. So if someone had taken a break in coverage, so for example, if we're taking a look at the return and we're preparing it and they say, I did not have insurance coverage for November or December for 2018, we're good. We can go ahead and take that. That's less than 3 months. But if they have a coverage exemption they had taken in the prior year, if they did not have coverage for November and December of the prior year, we need to look back to that prior year and make sure that if they're trying to take a coverage exemption for January and February of the current year, did they take anything in the prior? So we'd have to add those prior months into that calculation. So if they took a coverage exemption for short-term gap in 2017, by not having insurance in November and December, and they try and take it for January and February for 2018, it's not going to count. That's actually 4 months of coverage gap, not less than 3. So we have a look back provision, but not a look forward. So if someone wants to take the exemption and they didn't have coverage for November and December, we're fine. But you may want to remind them that next year, they were not able to take that short-term gap unless they have coverage beginning at some point in January of 2019. So that's going to be our one little wrinkle with the short-term coverage gap. There are a couple others that we can put in here. If you have a citizen living abroad for at least 330 days, we can enter a code C, probably not as typical. We do have a number of people in the county participating in health sharing ministries. So there's kind of an alternative program that they can join. It's a relatively cheaper environment than traditional insurance. Again, if they tell you that they're participating in health sharing ministry, we can enter a code D that would qualify for an exemption to either the minimal essential coverage or the shared responsibility payment. Incarceration, that would also be a valid reason why you don't have insurance. You don't really have choice of physician while incarcerated. So you do have coverage provided by the penal system, but you're not responsible for your own coverage. One thing we may see is this code H. We only really need this if we have to go through the 8965 otherwise. That would be in case of an individual dying or being born throughout the year. The government is very kind to say you do not need coverage if you're not living. So if you were not living for the entire year, you do not need coverage for the months that you were not here. So basically we'd say if we have a child on the return and they were born in October, we don't need to worry about the coverage prior to October. They weren't around. So we just put code H, mark off the months that they are eligible, and we will not calculate a shared responsibility payment. One of the other interesting parts that we have are certain religious sects. So depending on where you're at here in the county, you may have Amish, you may have certain Mennonite or Brother denominations that are exempt from healthcare coverage. Traditionally Amish because they do not believe in insurance products or don't believe in technology, but yet they have to log into the marketplace to request an exemption, which I find the most ironic of all, that they need to go ahead and get their own exemption certificate by contacting the marketplace, either by logging in on their personal computer or using their cell phone. So just a little bit of irony here in Lancaster County. Traditionally, you would not expect the Amish to have to use technology to log in, but they are going to be granted exceptions. Now, most of them already know this. This is kind of a unique issue. If you are dealing with Amish clients coming into VITA, they already know. Their bishop has told them how to go ahead and get the exemption. And traditionally with Amish, they add a couple kids each year, so they're pretty familiar with the process of getting new exemptions. So traditionally, they're in pretty good shape with it. Now, there are a couple other exceptions that we want to take a look at, and there's this hard place exception granted by the marketplace. So we kind of mentioned that the marketplace may grant you a coverage exemption. That would be part one. You're going to get a code, much like if you're going to get a religious exemption, you're going to get a code from the marketplace to enter, which will go ahead and make sure that they don't have any shared responsibility payment. But there are certain exemptions that the marketplace can grant. And traditionally what we'd recommend the client to do is to call or contact the marketplace and explain their circumstance. The marketplace can grant them an exemption. They can go back and grant them an exemption for the period of time in which these elements applied. We can also go ahead and file a return if the taxpayer says, I didn't get coverage, and they may meet one of these areas and they didn't yet contact the marketplace. We can actually put pending in for the exemption number as long as you're going to go through the process. Just bear in mind, if you put pending down for a coverage exemption, you'll probably get contacted by the IRS just to ensure that they actually did get some sort of coverage exemption. But if they do qualify and they are going to contact the marketplace and we don't get an exemption number before we have to file the return, we can mark pending down on the 8965. And a couple of the issues that we take a look at here are listed here on your handout. Things like homelessness, if they've had eviction in the last 6 months or facing eviction or foreclosure, if they've had a utility shut off or a notice about shut off, if they've been a victim of domestic violence, they've been determined to be eligible under the appeals process but have not yet been enrolled. If there was a disaster that resulted in significant property damage, bankruptcy, significant debt from medical expenses incurred within 24 months, high expenses for caring for the ill, aging, or basically an aging relative. So if they have costs incurred because they're caring for a parent or a relative, that could actually help them get an exemption from the marketplace. Again, we're not granting these to them. We're just mainly informing them of their opportunities to contact the marketplace and describe their situation. So the marketplace may grant them an exemption from healthcare coverage if they meet one of these qualifications. Medical support order. So if a spouse is required to provide medical coverage for a child and fails to do so, you may get an exemption for that. Recent death of a close family member, things along if they're determined to be ineligible under Medicare and they've gone through, or Medicaid, this is really not applicable here to PA for extension purposes. If they had a individual plan that was canceled under their policy. So we're seeing a lot more areas where they may have had individual insurance and now the insurance companies are canceling the individual plans because they just are changing the way in which they're providing insurance coverage, or other hardships. Any of those qualifications can allow the individual to contact the marketplace and be granted an exemption. So if they come in and say, I don't have insurance, there were a couple months where I could pay for insurance, I was homeless, I was under threat of eviction, I had a utility shut off, we may suggest that they contact the marketplace, explain the situation, and be granted a marketplace exemption. We can enter the code on the 8965. If they don't have the code by the time that we actually file the return, we can put pending, but we probably do want to follow up with them. Again, this will probably be a situation where they're not expecting to walk out that day with all of their information. This may be a return we may need to hold for a little while and walk through. Traditionally, it's because the system will try and calculate a shared responsibility payment, which will either impact the size of their refund or cause them to pay money, both of which are situations the taxpayer doesn't really want to do. So if we have an opportunity to work with them, we may be able to provide some assistance in having them contact the marketplace. All right, getting into our coverage unaffordable. This is the one area that we're going to take a look at here in terms of calculations that we can actually do for the taxpayer. The system will automatically calculate the income below the filing threshold. Tax layer is pretty good at understanding, did your income reach beyond the filing threshold? That will automatically generate our first coverage exemption. That's automatic. This is a little bit more of a unique situation. This is again going into determining whether or not the healthcare coverage is going to exceed more than 8.05%, a nice even round number that everyone can memorize. 8.05, because 8.04 just didn't seem like enough, and 8.06 was way too much. So 8.05% of your income, if it has to go to health insurance, it's considered unaffordable. So that's kind of the baseline of what the IRS has said of how much of your income you can actually pay for insurance. For those of you who have priced insurance lately, that doesn't seem like that high of a number, right? It's a fairly high cost for insurance if you try and get it individually. So most times that we're going to take a look at this is because we may have a situation where coverage is going to be offered from an employment context, potentially, and it's not going to be affordable for the employee. So there's three different contexts we can run into. First is that the employee is offered coverage from their employer and it's not affordable. There's a certain test we can run through that. The second test would be if any dependents on the return were offered family coverage, but that coverage was unaffordable. And the third test would be if they're not offered coverage at all, how do we go through the process and determine whether or not that coverage was affordable? So if we have one of those first two scenarios where there's insurance offered by the employer, either for the individual or for family coverage, we need to get some information from the employer. The first thing we'd probably take a look at would be for the employee only, we'd be getting a form from the employer. It's going to be a form 1095-C. That's going to give us the information that the employer has indicated is the cost of healthcare coverage for employee only. So that'll allow us to complete the first test, to go through and determine how much was that offer of coverage. And we can compare that number basically to 8.05% and determine whether or not that amount exceeds it. So for those of you good at algebra, you don't need to worry about it. The system will calculate it for you. Or you can do it in your head, whichever way you prefer. But what we can do is understand if that coverage is too high, if the amount that the employer is requesting for co-payment is more than 8.05% of that individual's income, coverage is considered unaffordable. Now, the downside is that the Form 1095-C will only provide information for the employee, typically. For family coverage, which a lot of employers do offer the ability for you to have self-coverage or family coverage, we may need to get that premium amount from human resources. So the taxpayer may have to go back to their employer and request how much was our premium for family coverage for 2018. So we may have a little bit of an issue in terms of getting that information, but again, what we're trying to do is to provide an exception for the coverage unaffordable. So in most cases, they may want to take the extra time to call their HR and try and get that policy. We may run into a little bit of issues here if they have worked at multiple locations, but even so, if they can go back and contact, most HR departments understand why you're contacting to say, I'm trying to do the coverage unaffordable and I need to know the cost of family plan insurance. Now, if you do not have coverage options from your employer, and where we're seeing a lot of employment context, maybe we have individuals coming to VITA that instead of having one full-time job, they have multiple part-time jobs. And kind of the opportunity for an employer is if you don't have an employee meeting full-time status, you do not need to offer healthcare coverage. So if an individual does not have the opportunity to purchase healthcare through their employer, we have to look to the marketplace affordability calculation. And that information is going to be on the H20 of your 4012. So that's actually going to go through some calculations. This is going to go through a little bit more detail in terms of doing some additional work for us. This is going to have to go through and calculate what our lowest cost bronze plan would be. And for those of you who have never heard about the Affordable Care Act, we effectively have Olympic-like credentials for insurance. The bronze, you did fairly well. You got into the games, you're on the medal stand. Bronze is our lowest level of coverage. Then we go to a silver plan, and then we have a gold plan. We don't really need to worry about the gold plan here within VITA. We're predominantly concerned about lowest cost bronze and silver plans. We actually can go through the calculations of how that will work. And not to scare people away. We only have to start looking these things up if we're going through the coverage unaffordable criteria. And we're going to show a couple shortcuts as we go through the process here. If we have a situation where an individual has not been offered insurance by an employer, they're not getting a Form 1095-C, then we can go ahead and use marketplace information to determine whether or not coverage from the marketplace would have been considered unaffordable based on their level of income. So there are a couple things that we take a look at. One of the areas that we'd have would be on the back of your packet. We're going to have the coverage unaffordable exemption guidelines. So if you don't want to try and read it off the slide, which is going to be very microscopic print, you do have it on the back of your handout, which is a little larger view for you, to take a look at what VITA has put together in terms of what our guidelines would be, kind of a rough guess, if you will, as to whether or not an individual can qualify for this coverage unaffordable. Basically breaking it down and saying how much income would we need at around that 8.05% based on their family size and other criteria. So what we're looking at is that they would effectively have to be in that 138% of federal poverty level. So what we're going to take a look at is box number 1 and effectively take a look at how much income would the taxpayer need before we start going through the calculation. If a taxpayer says, I don't think coverage was affordable and their income was $50,000, tough luck. It probably was affordable. We can go through the calculations if you need to, but just to let you know, you probably don't need to kind of waste your time or the taxpayer's time by going through those calculations. But what we want to show you is in part 1, we have household size here, which would be 138% of the federal poverty line. So for one individual, if their income's under $16,643, typically they could qualify for the hardship situation. So we could go through the calculation. It would make sense to do it in that context. If they have 2, it bumps up about another $6,000 and keeps increasing about $6,000 per individual added. So if they have a household size of 5, that would be just under $40,000. They should qualify for the coverage unaffordable exception. So again, if they come in and they're a single individual and they're making $35,000 a year, they were not offered insurance through their employer and they say, I believe it's unaffordable, most likely it's not unaffordable for them. They won't meet that qualification. We can still go through the calculations, although just to warn you, it's probably going to be ending up that they're in a shared responsibility payment scenario. So anyone in box number 2, this is over 400% of federal poverty level and within scope of VITA would qualify for the exemption, assuming all the other rules are met. They are not eligible for a premium tax credit if you're over 400% of federal poverty level. But we only run into a couple scenarios where they're still within this range and eligible for VITA services. So we're only looking at one household, one individual in the household who can still potentially qualify that we may want to go through that calculation. So the first 2 tables are basically taking a look at 138% of federal poverty. The second table looking at 400%. The last table is taking a look at the individual as a smoker. This is one area where you probably want to omit if you do use tobacco products. Apologies for those of you who underwrite life insurance when people aren't necessarily truthful about do they ever use tobacco products. This is one time people may want to admit that they use tobacco 4 times a week. Whether that's cigarettes, cigars, smokeless tobacco, chewing tobacco, snuff, whatever they're going to be using would be considered tobacco products. As you can probably tell, tobacco users have a higher rate of insurance. So what that means is that their coverage is much more expensive if you're a smoker. So if you are smoking, your household size is going to be allow you a much greater amount of income that you can still be considered coverage unaffordable. So if you're single, that goes up to $30,000. Just kind of shows you the difference in premium for health insurance for being a smoker versus non-smoker. If you have 2 individuals in your household, it's $40,000, about $18,000 higher than what you have for a non-smoker in terms of income level. So just giving you kind of a rough estimate to see where that coverage unaffordable may come in. And we don't want to scare you. Not everyone coming in is going to be looking for the coverage unaffordable. In most cases, we can either get them to qualify under the minimal essential coverage, meaning that they have some sort of Medicare employer plan, government plan, or through the marketplace. If they have those situations, if they go through the marketplace, we take a look at the advanced premium credit or premium tax credit to make sure that their income that they're reporting on the 18 return is similar to the income that they estimated for the premium credit. We only get into these situations if an individual does not have insurance for all or part of the year, and then we can go through the calculation. So we don't want to scare anyone to say, oh, by the way, now we need to understand what the terminology means of 138% of federal poverty levels, and do you have to prove the individual smokes in order for them to get into a new area? So you do not have to offer them a cigarette and see if they are willing to smoke it. You do not need to do that. Some cases it's going to be fairly obvious that they're smokers when they come in. Other cases they will generally admit that they are a smoker, and that might be one of the reasons why coverage may be considered unaffordable. All right. So again, you'll see it in your slides, but probably the better readability one will be the one on the back. Again, kind of a guide that we use within VITA to kind of indicate whether or not kind of coverage unaffordable makes sense to go through the calculations. All right. Just want to kind of mention again about the short-term coverage gap, just to reinforce the fact that the coverage gap is for less than 3 months. Again, we just have a little bit more information about that look-back period in here as well. So again, you do not need to worry about short-term coverage if it's less than 3 months. Any part of 1 day of the month will count as a full month. You can piggyback these exemptions off other ones too. So if you were incarcerated, you had a short-term coverage gap, and then you got coverage through an employer or through a government program, we can use multiple exemptions throughout the year. But if your coverage gap is for 3 months or longer, you may not use a short-term coverage gap. You can't use that to help bridge. So if you have it for 5 months without coverage, you can't basically exclude 2 months. You would not be eligible for the short-term coverage gap. All right, so nothing like a quick morning session of ACA. But again, the main thing we'll probably take a look at here, a lot of our clients, particularly if they're retired, are probably going to qualify under Medicare. So they don't need to worry about kind of the whole process here with the Affordable Care Act. If they have coverage through their employer and they're actively participating, they don't need to worry about it. They have minimal essential coverage. If they're through the marketplace, we're basically going to take a look at that Form 1095A and enter the information. The one issue we may run into there is whether or not that premium credit was calculated correctly. So there may be some additional monies coming back. Or again, if they had more income than expected, there might be some repayment of those amounts. Where it gets a little bit tricky is where someone did not have coverage. This has been several years we've had ACA, so